Here is a summary of the SiriusXM Second Quarter 2025 earnings call, focusing on key financial metrics, management forecasts, risks, highlights, lowlights, and important statements from the CEO and CFO. Introduction and overall performance. Hooper Stevens, Senior Vice President of Investor Relations and Finance, welcomed attendees to the SiriusXM Second Quarter 2025 earnings call. Jennifer Witz, CEO, and Tom Barry, CFO, provided the prepared remarks, joined by Scott Greenstein, President and Chief Content Officer, and Wayne Thorson, Executive Vice President and Chief Operating Officer, for the Q&A. CEO's key highlights and statements. Jennifer Witz emphasized that the second quarter was a period of great progress, driven by a renewed strategic focus, deeper listener engagement, and operational improvements. Content investments. A significant highlight was the new agreement with Stephen A. Smith, who will host a daily sports show and a political/culture program that will also be a podcast. This reflects SiriusXM's strength in sports audio, live coverage, fan interaction, and monetization across subscription and advertising. Subscriber growth. The company saw a year-over-year improvement in self-pay net adds for the fifth consecutive quarter, with an increase of 32,000 in Q2. This was attributed to new acquisition initiatives like the automotive dealer 3-year subscription program, now with Audi as the 8th OEM partner, enhanced used car owner data, EV expansion, and the Podcast Plus package. Strategic initiatives. SiriusXM launched SiriusXM Play, an ad-supported subscription plan featuring a subset of music and talk programming, expected to be available in nearly 100 million vehicles by year-end. This rounds out their pricing and packaging strategy to cater to price-sensitive customers. Advertising technology. Advancements in their ad tech stack include ad replacement capabilities on 360L vehicles by year-end and streamlined purchasing across satellite, streaming, and podcasting. They also announced an agreement to improve audio's representation in media mix models and launched an AI voice replica capability for advertisers. Market challenges. The advertising market faces challenges from economic uncertainty, budget pullbacks, and a shift to lower funnel channels. Streaming pricing is also pressured by excess CTV inventory and competitor reactions. Podcasting strength. Podcasting continues to be a bright spot, with ad revenue climbing almost 50% year-over-year. Investments in content, video/social inventory, and technology are yielding results. Recent podcast deals include Morbid and Trevor Noah's What Now? Future outlook. Witz expressed confidence in their strategic priorities and the ability to deliver on financial targets, supported by strong cash generation and cost efficiency. CFO's key highlights and statements. Tom Barry highlighted strong financial discipline, healthy margins, accelerated cost savings, and substantial free cash flow generation. Revenue. Total revenue for the quarter was $2.14 billion, down 2% year-over-year, with similar declines in both subscription and advertising revenue. Adjusted EBITDA. Adjusted EBITDA was $668 million, down 5% year-over-year, representing a healthy margin of 31%. Free cash flow. Free cash flow rose 27% to $402 million, attributed to payment timing, lower capital expenditures, and the elimination of Liberty overhead from the prior year. Cost savings. The company now expects to achieve approximately $200 million of gross savings this year across OPEX and CAPEX, exceeding their initial goal. Non-satellite CAPEX is expected to be near the lower end of the $450 to $500 million range, with a further decline to $400 million next year. Expenses. Sales and marketing expenses declined 20% due to efficient campaigns and timing, though some reinvestment is expected in the second half. Product and technology costs fell 20% due to optimization. G&A increased by 23% primarily due to higher legal expenses compared to a prior year insurance recovery. Organizational realignment. SiriusXM undertook a technology and workforce realignment, including a $100 million write-off of capitalized software assets and a 20% reduction in contract product/tech workforce and 10% in full-time employees. Subscriber acquisition costs. SAC increased 16% year-over-year to $107 million, reflecting investments in high-quality channels and automaker contracts, with SAC per installation at approximately $18. Segment performance. SiriusXM. Revenue was $1.61 billion, down 2%, driven by a smaller self-pay base. ARPU was stable at $15.22. Segment gross profit was $966 million, with a 60% gross margin. Self-pay net additions improved by $32,000 year-over-year to negative $68,000, driven by gross adds and low churn, 1.5%. Pandora and off-platform. Revenue was $524 million, down 3%. Subscriber revenue declined 6%, and advertising revenue fell 2%, offset by strong podcast monetization, nearly 50% ad revenue growth. Segment gross profit was $154 million, with a 29% margin. Capital structure. The net debt to adjusted EBITDA ratio ended at 3.8x. The company returned $137 million to shareholders through dividends, $92 million, and share buybacks, $45 million. Full-year guidance. SiriusXM is reaffirming its full-year 2025 guidance for total revenue, $8.5 billion, adjusted EBITDA, $2.6 billion, and free cash flow, $1.15 billion. Potential upside to free cash flow is seen from tax benefits and lower CapEx, with an update expected in the fall. Key financial metrics. Revenue, $2.14 billion, down 2% year-over-year. Adjusted EBITDA, $668 million, down 5% year-over-year. Adjusted EBITDA margin, 31%. Free cash flow, $402 million, up 27% year-over-year. Self-pay net adds, minus 68,000, improved by 32,000 year-over-year. Churn rate, 1.5%. ARPU, $15.22, essentially flat. Improving trends. Net debt to adjusted EBITDA, 3.8x. Cost savings achieved/expected, $200 million gross savings for the year. Management's forecasts for future quarters. Subscriber expectations. Full-year subscriber expectations remain unchanged, despite a strong first half, due to anticipated headwinds in the back half. ARPU trends. ARPU trends are expected to continue improving through the year, largely due to the March rate increase. Net adds. Some change in seasonality for net adds is expected this year compared to prior years, with a projected reduction of 300,000 net adds for streaming subscribers. The in-car business is performing well. Full-year guidance. Reaffirmed guidance for revenue, adjusted EBITDA, and free cash flow for 2025. Potential upside to free cash flow exists due to tax legislation and lower CapEx. SiriusXM Play, expected to contribute to improved subscriber results, with scaling at a thoughtful rate. More impact on results expected in 2026. Capital allocation. Continued reinvestment in the business, maintaining the dividend, deleveraging, and a focus on buybacks in the latter half of next year. Significant risk factors. Advertising market uncertainty, economic, consumer, and tariff uncertainty impacting advertising spend, with categories like retail being more adversely affected. Streaming pricing pressure. excess CTV inventory, and audio competitor reactions impacting streaming pricing. Streaming marketing spend pullback. Intentional pullback of streaming marketing spend is expected to impact comparisons in the back half of the year. Macroeconomic trends. Closely monitoring macroeconomic trends affecting the outlook. Impact of new legislation. Understanding the full spread of benefits from the new tax act over multiple years. Click to cancel. Regulation. While federal regulation is suspended, state-level rollouts of click to cancel could slightly impact subscriber outcomes. Highlights. Fifth consecutive quarter of year-over-year improvement in self-pay net ads. Strong growth in podcast ad revenue, nearly 50% year-over-year. Successful launch of new initiatives like the Stephen A. Smith deal and SiriusXM Play. Significant cost savings achieved and exceeded. Substantial increase in free cash flow. Improved performance in subscriber acquisition programs and low churn. Advancements in advertising technology and AI capabilities. Strengthening of financial position and continued shareholder returns. Lowlights. Overall revenue and adjusted EBITDA were down year-over-year. Pandora ad revenue saw a decline. Subscriber acquisition costs increased year-over-year. G&A expenses were up due to higher legal costs and lower prior year insurance recoveries. Streaming subscriber numbers are expected to decline. In summary, SiriusXM demonstrated solid execution in Q2 2025, particularly in subscriber acquisition and cost management, despite ongoing revenue headwinds and market uncertainties. The company is strategically investing in content and technology to drive future growth, with a clear focus on enhancing both its core subscription business and its expanding advertising offerings, especially within the booming podcast market.